Hello, everyone. Welcome to this panel. Very much looking forward to talking to you all today. We're going to be talking about how well the mining industry is moving from desire to action when it comes to ESG. As an investor myself, I know that ESG has moved from something on the fringes to very much in the mainstream, and one can't seem to pick up a company presentation anymore without seeing references to environmental, social, or governance factors there. But now that ESG is on everyone's lips, there's clearly a desire to get it right. It's a good time to ask ourselves this question about how well the mining industry is moving forward from desire to action. We're very lucky to have some esteemed panelists, a selection of individuals from across the industry. I'd like to introduce Caroline Donnelly at Sprott Resource Streaming and Royalty, Sean Uzma, Founder and Chief Executive, Triple Flag Finance, Evgeny Monakov, Head of Investor Relations at Polymetal, Elaine Dorwood-King, Non-Executive Director at various mining companies, and Jamie Strauss, CEO of Digby, and over 30 years experience in investment banking, small boutiques, and also an independent director. So without further ado, let's jump straight in. I'll plan to ask each of the panelists one or two questions. Feel free to jump in at any point with comments, and we'll also leave some time for questions at the end. So I'll kick off with Caroline, if I may. Caroline, you see a lot of projects from the inside in a way that many public investors do not. How do you consider ESG factors when judging the appropriate terms in a streaming or royalty deal?
Yes, thank you, Tal, and good morning, good afternoon to everybody. So at Sprott Streaming and Royalty, we are a fund that invests into streams and royalties across the world, predominantly pre-development stage companies, so companies that have been through some sort of studies and are looking to head towards construction. You know, at that point in time, we typically find that most of the companies we deal with are listed, so they have some requirements around what the stock exchanges want, and there's quite a lot of public information available. We also find at that point in time that they are, if not fully permitted, then at least mostly permitted. So they've been through quite a long process by that stage around both the environmental and the social aspects of the project. So, you know, we're not looking at projects from a very early stage when companies are really just starting off. We are looking at them at a slightly later stage, which gives us a lot of information to review. So, you know, that really forms the building blocks of what we look at. You know, I haven't spoken any about governance at all in there, so obviously governance becomes an important piece of it. And for us, if we find something which is a fatal flaw in any of the ES or G factors, we will walk away. That for us is a critical piece of the deals that we do. And so it's a consideration as we go through our entire process of deciding whether to move forward with a deal, what we do in our due diligence, pricing, terms, etc. And where there are projects where there are issues with ESG, I think it's very hard to price around it. You know, you can't charge somebody more for bad governance. Like for us, if there's bad governance, we need to walk away. So, you know, for us, the terms, coming back to your question, Tal, tend to revolve more around what do we see are the risks in the projects and what are the risks that can be appropriately mitigated as far as ESG is concerned.
Can you give us an example of what a fatal flaw might be?
You know, something on the reputational front with the people involved is an absolute red flag from day one. And, you know, we have large institutional investors that provide us with capital to deploy. They are just as capable of doing a Google search as I am. So I would say to management teams out there, if you put your name into Google and something untoward comes up, you know, you might want to figure out either A, a good answer as to why that happens, or B, potentially find other, you know, capital providers that wouldn't be us.
Understood. Thank you. Sean, could I ask you the same question? How do you go about considering ESG when judging the terms of a streaming or royalty deal?
Yeah, Morning, Tal, and look, thanks for the opportunity to talk about this, because it's increasingly in stark focus, I think, for everyone. Our business has been around now a little over 5 years, and in fact, the very first opportunity we looked at was probably a good example of this being a filter for the same reasons that Caroline alluded to, namely reputational issues, both with community as well as some of the management teams involved that we sort of backed away. The returns look good, but I sort of characterize it as a third rail that you just don't want to touch. You can't cleanse it with a higher rate of return. So for us now, I guess in the 5 years we've done about 16 deals, but we've looked at over 500. And the number of times early on that an ESG filter in a sector that's quite small trips up is actually, it's not unusual. I find for us, particularly in the royalty and streaming space, our time horizons are typically longer than I'd say probably your average equity and even debt investor. These are life of mine contracts that could go on for many, many decades. And so it's just bad business to be in a partnership with someone or in the passenger seat with someone who out the gate you've got concerns about. And I think, once the single greatest impact that we have is ultimately where we choose to deploy our capital. We're not operators. And so I think the diligence you apply, the technical work up front is probably the more actionable, easier component to that. But I think being able to do very good work on understanding the reputational components, the anti-corruption aspects, I think maybe even harder, the governance points that Caroline talked about, because we've sat on a number of boards. I think over time, you really see that the sector has some way to go, I think, in the governance space. And I'd say the last piece from my side is even in some of the largest, most capitalized, well-disclosed organizations out there, we've seen effectively breaches that, transcend and come down to leadership. And I think that's the challenge for us, is you've got to look beyond policy and just what people say in their documentation and try and form your own views. So we've invested in sectors where we do screens of the country proactively. We put ideas in front of miners, but we screen viable partners in the beginning on these grounds, and then narrow that down to a group that we think we can effectively transact with. And it remains so subjective, because we've done one transaction in a region where a well-listed partner or peer has actually done a transaction we rejected. And I'm sure they're going to do very well. So they arrived at a different conclusion to the one we did. But I think, that concern that I'd rather stay back from an area that we see smoke just in case there's fire is something we tend to adopt.
Yeah, you raise an interesting point. ESG is often not black and white. It's shades of gray. And I've often found that information can sometimes be hard to come by and sometimes be overwhelming. Do you think it might help if your endeavors, if the industry were to adopt a standardized forms of disclosure that could credibly track the progress of a company, its projects, and its management in executing an ESG strategy?
Yeah, the short answer is yes. I think that'll take a while. We're in the process of putting out our first ESG report actually this month, and trying to link the various reporting standards and that across, just so that users who have those different frames of reference can actually cross-reference and understand how to think about it on a more holistic basis is what we're trying to do. It would really help if there was some harmonization. Yes,
well, hopefully that will come with time. If I may, I'll jump over to Evgeny. It'll be interesting to hear the perspective of a listed company. As a public equity investor, I know that we and other investors are increasingly considering ESG factors, and the sell side are responding with more published research in this regard. What do you find is the biggest frustration when it comes to communicating ESG, or what I would call non-financial performance, to investors?
I think you're on mute.
I think
yep.
I was on mute, sorry. Thank you, Tal, and it's a pleasure to be on the panel with such esteemed colleagues from the industry. Tal, your question is quite relevant. I would probably single out one aspect of a lot of things which may appear to us to be frustrating in our communication with investors and various stakeholders. It's probably the lack of appreciation by the market for the specific action plans that the company comes up with when they pledge some sort of a goal of carbon emissions reduction in the future. We see quite a lot of pledges and net zero sort of commitments coming out. And more often than not, we see very little substance in those commitments and those announcements. When someone does a lot of work and provides a lot of sort of meat on the bones about the engineering contracts, about the specifics of the projects, how this is going to be achieved, by spending how much, in what areas, how it's going to be verified, monitored, punished or rewarded, we unfortunately do not see market really reacting to that in a way that we would hope it would react. It seems like most of the people just tick their box and move on. I think there is a risk that this sort of wave of pledges will result in a lot of sort of embarrassed faces a few years down the line, provided that the executives that make these net zero pledges are still around in 10 years' time.
Yeah, yeah. And just coming back to this notion of data and disclosure and standardized disclosures, as a company communicating with investors, how do you decide which standards and reporting venues to subscribe to, and which, from your perspective, are the really key standards to adhere to and report on? I'm sure a lot of companies listening to this would be keen to hear that answer.
We talk to our shareholders, Tal, and we talk to our various stakeholders, and we try to see which standards or which reporting frameworks would cover most of sort of the ground for the people that have the capacity to invest in our stock and support us. So we've come over the last 5 years by trial and error. We've come to basically a framework where we report in accordance with Global Reporting Initiative, the sustainability reporting standards issued by them, including the metals and mining sector disclosures published by SASB, and our reporting is in full alignment with Task Force for TCFD. So these are the three reporting sort of frameworks that we rely on, and we think they cover most of the ground and most of the areas that our shareholders and investors care about.
Understood. Thank you. I'm going to move on to Jamie, if I may. There's sort of an interesting aspect here of companies reporting ESG at a high level and then the project level. And I know you're associated through Digby with a lot of in-depth digging into projects, if you'll excuse the pun. We hear a lot about corporate level ESG performance, but a lot less so at that project level. How are you finding how much ESG is factoring into analysis performed at the project level itself?
Yeah, I think thanks, Tal, and morning or afternoon to everybody. And I think, first of all, it's probably worth just explaining what Digby ESG has done, because I think to some extent it addresses some of the things Evgeny and Sean were highlighting. One of the issues with regards to ESG, particularly in the junior mining sector, but maybe throughout many other industries, is there's a huge desire to want to disclose ESG, but there's a lack of knowledge of knowing what to disclose. And so when we started looking at this and when we were encouraged to come up with a solution for this, the important thing was to not only to consider all of the key standards with which some of us have been talking about today and making sure that they're appropriate and right-sized, but also to make sure that they addressed greenwash, which really, I guess, is where your question effectively is coming from. Greenwash, not specific to the mining industry, but for the whole ESG, I don't know, call it a movement or whatever, is a big issue. And particularly with regards to the mining space, that we have, at the end of the day, we're touching people in a very significant way in the mining space. We're touching the environment, not just from an emissions basis, but also from nature point of view. So it's really important that this addresses the real basics of mining on the ground and at the project level. So the question sets that were designed and developed for the mining space through Digby ESG, which are right-sized from an exploration, development, and production basis, where they work and interact throughout each other, very much address these key issues at the project level going up to the company, and therefore hopefully addressing real ESG, and which ultimately then can be used maybe in a year's time or 2 years' time by Sustainalytics or MSCI or whatever to improve their own algorithms in how they're effectively addressing this. Because the issues with which other members of this panel have highlighted is we're not particularly, Evgeny's point is, you put out all of this information, but it's not being properly understood and properly diagnosed and assessed. So hopefully this solution will allow the whole industry to come together. We can work together to have a single set of frameworks to allow us to disclose, while also being supported by GRI, SASB, and others alongside that process.
Right. And are you finding that the ESG at the project level and the ESG at the corporate level connects with each other? Is there sort of a read across from one through to the other, or vice versa?
Yeah, so just to explain the basis, so every company that effectively goes through a submission basis, which is then independently assessed by a third party, has a corporate question set. So if you take a development stage, so post PFS level, there's a corporate set of questions, about 30 questions. And then there's a project. For each project, there is a separate set of questions, which is about another 70 questions or so on top of that. The E, S, and G is not siloed, although the corporate question set does dominate the G side of it, or G is dominated within the corporate side, but they are not siloed within those three different things. So yes, there is a good read through throughout the whole of that.
Great. Well, it's great to see that this is all starting to connect together as we go forward.
I should add, Tal, that Elaine is one of my wonderful advisors on our advisory panel, and she signs off on all of these different frameworks. So she can probably attest to how some of these things are put together as well.
What a wonderful segue towards Elaine, who I was about to jump to. So Elaine, you're a director of various mining companies, and you're seeing this from yet another perspective. I wouldn't want you to give away any specifics about the particular companies on whose boards you sit, but it'd be really interesting if you could describe in general terms the journey that ESG is taking at the board level, in terms of the time it takes, it's debated, even the skill sets that other directors from your perspective have, and also whether it's seen as a risk control function or a value creation function at the board level.
Well, thank you, Tal. Thanks for having me this afternoon, and hello to everybody. It's good to be here. You know, the mining industry has come an enormous way in the last decade, 2 decades, with regard to ESG. We didn't call it that always at the time. And certainly in the last 5 years, I think boards are much more attuned to the need to ask better questions, to quiz management and probe more deeply about what is actually going on in terms of especially social and environmental performance, taking a hand in what policies and commitments are, and recognizing, I think the mining industry is ahead of many industries with regard to ESG, because it's such a viscerally important thing that we get social and environmental performance right. It can impact our ability to deliver on business strategy, on our flexibility to operate, and almost everything else if we don't get it right. And we've had to learn that lesson over and over again. I think that companies' boards think about it nowadays both from a risk management or risk control point of view, which I I would call, the way that we would think about that is preserving value preservation, which is easier for people to get their mind around when you're talking about risk. Most people think about the threat side of risk rather than the opportunity side of risk. But more and more, the companies that are beginning to integrate ESG performance into their overall business strategy are seeing the opportunity side. And that's the value creation side, the understanding that if you deeply understand both the threats and opportunities that are coming to you, sometimes externally, that you may have difficulty controlling, you can create room for growth and room for opportunity in your company. And boards can take a real role in helping management see that if ESG is integral to your strategy, you have much more opportunity for that. If your business strategy, your business plan, your investment decisions, the people you put in leadership positions understand that it's not an add-on, it's not something over to the side, that it really is a fundamental piece of your business, you're much more likely to be able to create that longer term value that is so important. And because it is often longer term, it's harder for us to talk about. It's harder to quantitate and harder to measure. So I think that's one of the places that, it's a challenge for companies, but a place that boards can play a role. And one more point would be that a board can also have an important role in ensuring that companies over time have consistency in how they approach these issues and how their values are reflected in the culture of the company and how that reflects then in the actions of employees. And we have examples of, where companies can have put together good approaches, solid systems, and have good performance, and those things can slip, whether that's from complacency, change in leadership, the wrong rewards for leaders. And the board can certainly play a role in helping support management to get that right over time.
And when we're sort of talking about moving from desire to action, what, if any, are the challenges you see in moving from desire to action at the board level?
Boards are increasing their capacity to ask questions in this area. I think every board should have at least one person, mining companies now, talking about mining companies, with some operational project, geotechnical, HSE, whatever it is, but some practical experience in the industry so they can ask some of those probing questions. I also, though, think that nowadays all boards should have some facility around broader ESG issues and have some familiarity with them. It shouldn't be something that is a committee that only rarely comes to the full board table. I think committees are important for conversations, but full boards need to be aware of what's going on and be cognizant of the fact of how important these areas are to the overall long-term performance of the company. And so more and more boards are recruiting people that can bring that expertise and that perspective that's a little bit different than some of the perspectives that have been more common around the board table in finance or other aspects of business.
Understood. Thank you for that, Elaine. We've had a question come in from the audience. It might be a good time to open this up to each one of you. Please don't feel obliged, but if you have something to share, just jump in. The question is, what are the common issues around safety and security for both people and assets for overall business resilience? Does anyone want to jump in there?
Well, I can take a stab at that. Commonalities around safety and security. Well, both of those things, typically when you're talking about a mining operation are about keeping either people or assets safe. And to do that, again, a lot of these things come back to leadership and the importance that's placed on how those attributes of running a business are placed inside the company, what kind of people you put into those roles, how you resource them, and how you make them more than simply activities, but they're core to how the company sees themselves. Safety, for example, most of us would say has to be a value of a well-run, responsible company. Well, if it's a value, it's something that lives here in your heart. It's not something you think about in terms of what the right actions and approaches are. And I think in large part, in many places, when you're talking about security and you're in parts of the world where people are desperate and are looking for any kind of opportunity, you've got to regard how you engage with communities and all kinds of stakeholders in the same values-driven, respectful, but firm way.
Tal, I would just add very briefly to Elaine's comments is that from a slightly different perspective, but I think ESG covers so many different topics, and this is a very important one which needs to be out and needs to be transparent with. And I think that actually the industry can probably be quite proud of its record over the course of the last year of improving health and safety generally within the industry. But now if we can get this out and if we can show and promote that within the industry as a whole generally on credible numbers and credible actions taken, then obviously I think that can help promote the industry as a whole and encourage probably a better perception generally.
Yeah, Tal, maybe just to add to that, you know, if I think back to when I started my career in operations in the 90s, you know, it felt very much you had the safety equipment, everybody was sort of saying the right things, but I think that point of leadership at the time, it felt to me that in a lot of the organizations that I worked in, it was production above everything else in so many ways. And when you had a safety incident, you know, people would look back at policies and find reasons why, you know, things happen, and somehow either the operator or individuals were at fault more than, you know, how do we actually engineer out these things and actually have the right mindset? And then it felt to me like we've migrated to sort of managing numbers over a period of time as opposed to actually having that right, the sort of cultures and values. And I know these are sort of generalizations, but I do feel like when I look at a lot of the companies that we've diligenced and we partner with, generally, I think it's not a true across the board, but generally companies are laser focused on these things. I think some of the areas when you broaden this and you start looking at what was engineered back in the day into some of these, whether it's tailings or otherwise, how do you assess some of those risks and manage these risks? You know, what are you doing from a transparency and actually living the values that you have maybe on a glossy brochure somewhere? How do you demonstrate some of those? I think those are the areas that are perhaps a little less tangible, but are things that I think it's so important to try and assess.
Right.
Tal, if I may add from our point of view, the key issue here is how do you incentivize your people? I mean, what is the outcome that you want to reward? And that's how you maintain safety and maintain, you know, a record of keeping your people safe and your assets secure. I think with most of the accidents and problems arise when the system of incentives are aligned with something else but safety. I mean, safety is secondary to something else. And if you try to eliminate that, I think you will be, you know, almost there if you incentivize people properly. Yeah.
Remuneration is something I did actually want to ask each of you about, and certainly when it comes from moving desire to action, employee KPIs are arguably an absolutely key tool in directing effort and behavior. I'm keen to hear from each of you whether you would consider the integration of ESG into KPIs to be sufficient, excessive, or inadequate. And maybe I'll start with Jamie, because I know that you're the chair of several comp committees, and Digby ESG provides boards of directors with the ability to comply with these obligations. So it'd be interesting to perhaps to start with you on this point.
Yeah, I think this has been a big challenge. I mean, if you think about ESG covering 30 to 35 different topics, and typically one has found ESG for the mature junior industry, probably typically 5 to 15% of compensation scorecards. How do you fit 30, 35 topics into a scorecard objectively, and for a board of directors or a compensation committee to objectively manage that? So I think it's been a really, really difficult area to do it properly. It is becoming more commonplace to include ESG, but it's the objectivity of it across all of that spectrum, which is, I think, the complexity. We really wanted to try and address this right at the front, I guess, probably with the background that I had. And when you can get an independent assessment across the very specific questions that are designed and attached and aligned to the global standards, you can then make a more objective approach to this as a compensation committee. So I think the ability, I don't want to just always come back to Digby, but it was built to design to get around some of these problems, but the ability to try and objectively address all of these issues within and encourage boards of directors to incorporate this on an objective basis, I think is a big leap forward, because there's no doubt when people start to focus on ESG, and it is part of that incentivization plan at the management level, there are positive impacts that we can begin to start seeing happen.
So I'm sort of hearing from that response that it's probably inadequately built into KPIs because it's hard to measure at the moment. Is that fair?
Well, I think from my own perspective, with regards to being on chairing 2 comp committees, I think it's been very difficult. I mean, one of them is a royalty company, so it's probably not directly comparable because it's just they have different business. But it's very difficult to measure 30 to 35 different things, whether it relates to nature, obviously emissions to some extent, but more at the larger end, governing governance and all that. It's just very difficult to squeeze all of that objectively into 5 to 15% of a scorecard without having it independently assessed to a standardized structure with which you can then compare and contrast and have benchmarks or whatever it happens to be. If you can create that, it makes the job of a compensation committee, a board as a whole, and then management to be able to use it constructively to the benefit of what one's trying to achieve. But yeah, at the moment, it's difficult, a mess, and a bit of a squeeze.
Yeah. Do any of the other panelists have any reflections to share?
Yeah. Yeah, if I can.
The way I would look at it. Go ahead, Caroline.
Why don't we jump to Caroline and then Elaine?
Yeah, you know, I think about it more from a specific company perspective, as in what is it that the company is trying to achieve? You know, I think we can all agree, you know, Jamie said that there are multiple issues, multiple metrics, but if we're trying to measure every single metric, I think for every single company on a KPI basis, I think what you just land up with is a smorgasbord of, right, we need to get ESG right. You know, I think for me, it's each individual company needs to, and the boards need to consider what the important factors are in ESG, where they see that there are deficits within their companies. And to me, those are the things that the KPIs should address. And, you know, that then probably becomes even more granular than what you're talking about, Jamie. But, you know, hopefully it could, you know, maybe get rid of, I don't know, 20 of them and focus on 15 of the aspects, you know, and have those as being the more priority based, just given what the company is and what it's trying to achieve.
Yes, very interesting. So prioritizing amongst the smorgasbord would be a very useful thing to do. Elaine, what do you think?
Well, I was going to say almost the same thing, but in different words. I think, you know, every company has to figure out what their material issues are. And there's a process for doing that called a materiality assessment that should be one of the first things a company does before they issue a sustainability report, whether it's against the Global Reporting Initiative framework or whatever the framework is. And that means then they select out of that huge pot of things that are all important in the ESG spectrum, but may not be as important to that company in terms of their advancing their business and what their stakeholders care about. So the only thing I would say differently from Caroline is that it's not just the places where companies might have gaps, it's where there's materially important issues that the company needs to measure and communicate to their stakeholders how they're traveling against those things. And I would set targets for those. The advice I usually get is you pick 2 or 3 things that are the most important in the S and in the E and in the governance. That small basket out and you focus on those first for a couple of years. You disclose as transparently as you can and as specifically and quantitatively as you can how you're traveling against those things. The advice I would give.
Yeah, Tel, I think maybe just to tack on, if you zoom out for a minute and you look at this as just being, if you do this well, and it's just a part of doing good, sensible business under the privilege to operate ultimately in this sector. I think if you've integrated this well with strategy and you've got a longer term vision as to what you would like to be and look and aspire to be, not just within your own company, but how you fit within the sort of mining ecosystem. And then you've got a series of goals over different timeframes. I think that does focus you on a handful of things that, it gets the management team to focus on. And we just said at the start of this that, there's these different standards, like there's no harmonization. I think you can tie yourself up in knots if you're trying to manage to numbers or specific external things. So unless an organization has some strong leadership and conviction on these things, a grander vision of where they're going to go and actually living these values, and give the board as well some discretion to apply negative discretion in the event there's a failure beyond the scorecard, for example. If they're not actually living up to the values and the aspirations that are in there, I think you're going to drive the wrong behavior. Too finely disseminated scorecards, people end up managing towards those, and I think it can really drive the wrong outcomes. So I think you need a slightly more holistic perspective as you approach this. Yes.
One of the topics I wanted to discuss with you all is unanticipated consequences, which is sort of, we've been skirting around the sides of that in this particular topic on remuneration and how and what you want to get out of people. Often when a new behavioral and capital allocation driver emerges, there's quite a rush towards it, often with unanticipated consequences. And this ties into a question we've just received as well from the audience, which is, how at this level of ESG do you take care of the productivity of projects? And perhaps associated with that question is, from each of your perspectives, as we're moving from desire to action in ESG, what sort of unanticipated knock-ons would each of you be looking out for? If we could perhaps start with Caroline and then move on from there.
Yes, I'm always concerned when people rush to, without being too politically correct, the new religion. And I do sort of feel like with ESG, obviously the mining business has been involved in the E and the S side for, as Elaine said, the last 2 to 3 decades. I feel like the rush to ESG has been somewhat prolific, over the last sort of 3 to 4 years. And I think what concerns me is that companies look at that and believe that if they've ticked all the ESG boxes, then they don't have to make any money and they don't need to return returns to shareholders. And, to me, it's a balance. Like, shareholders are investing in companies and, invest in the mining space because they want returns. And, we're a very small sector on the global stage. I sit in Houston, and in comparison to oil and gas, we're a tiny little sector. And I think it's important for companies not to lose sight of the fact that shareholders invest because they want returns. Yes, the other stuff is all very important, and I'm not trying to dismiss it, but I think we mustn't lose sight of the idea is to return returns to shareholders, whilst achieving a whole lot of other goals and ambitions. And so to me, that is, sort of very broad brushstroke, one of the big concerns that I have with, the pendulum swinging too far in any one direction.
Sure. Sean, what do you think?
Yeah, look, I think Carolyn's point is front and center, but I don't think these things should be a conflict with each other. I do think if you do it badly, ultimately you're not going to be able to attract the right talent. You're not going to get the support from local host governments and communities if you do it particularly badly. And we've seen some examples over the years, obviously, of that occurring. So I think it's just good business, as I said earlier, for companies to do that. We've just come through an IPO, and it's been interesting to me because we've, as an organization, have prioritized a handful of things that resonate with ourselves as part of the sort of mining ecosystem as a capital provider. And so part of that is upfront partnering with the right groups, and we've talked about that and the diligence that goes into that piece. The other piece then is sort of just partnering with those groups with their own community initiatives and others. So, that's investing in their local community projects, things like scholarships and others that actually help support, I think, not just those local communities, but indeed, the mining effort in those regions. And the other piece for us is then is actually climate. And there's a lot of maybe, I'd say, varying degrees of lip service. I find some, for example, will look at their direct activities. I'll talk about carbon neutrality. But the real impact, certainly for what we do, is actually when you actually look at the metal that you own, the attributable components in those footprints. And we've done a lot of work to try and get to the bottom of that. And indeed, we've had to work with external providers to try and even just have a definitionally consistent approach, because the stuff that's reported with the miners, because of these different standards and approaches, you could drive a truck through because it's really quite divergent at times. So I think if you view this as a journey, rather than everyone's got the answers right here and now, you have your handful of priorities which will migrate over time, and you focus on stuff that you think is authentic, while making sure that, I think as someone on the panel said earlier, you are consulting with your shareholders. You're speaking to others who you see as leaders in this sector, and you're consistently trying to recalibrate what you think is the right thing to be doing in this area, as opposed to trying to just manage a score. I think that can make a real difference. And the last point I'll say on this is, when we were looking at, our prospectus and some of the materials, when we listed in May, we used some of our underwriters' ESG groups to review what they thought and provide us with feedback. And it was really quite interesting at times where you could see these groups felt like they were managing the scorecard, and it felt quite generic. Whereas, you had others who clearly had maybe advanced and were a little bit more thoughtful about it and could think about it on a discerning level. I really don't want to do the first bit. I think it's really trying to make sure that each organization figures out what that is that works for them and what's that grander vision of where they're headed and what role they have to play. So I don't know if that, contributes, but that's how we think about it.
Thanks for that. I think, Evgeny, I'd be very interested to hear your thoughts on unanticipated consequences of the push to ESG, and also maybe a direct response to the question we got from the audience is there a tension between ESG and productivity?
Well, actually, I was going to relate an anecdote from about 3 years ago when Polymetal was reviewing its incentive system for its personnel. We were trying to shift the focus away from volume-based incentives for the staff and more towards a more balanced outcome in terms of safety of the personnel and in terms of the safety and efficiency of the equipment. And there's been quite a strong voices of opposition inside the company, especially people with a long track records in the mining industry, saying that if you remove the volume-based incentive from the overall sort of soup, you will see a fairly material drop in volumes. Because this is what is actually driving people. This is what is, pushes people to achieve better and better, volumes in their shifts. And we took a risk, and we shifted the incentive system away from the volumes. And although the volumes did dip a little bit in the first year of the implementation of that system, then it picked up and then in a space of 12 to 18 months, the volumes were back to where they were before. And we had effectively a much better outcome in terms of the safety track record, and much better, and the same, if not better, volumes coming through. So the unanticipated or unintended consequence of that move was that people actually want to do well in their jobs. And people will try to do their best in their positions, even if you don't incentivize them massively, so that they end up risking or putting themselves at risk or other people at risk, or doing some things which are, with the benefit of hindsight, is not a very smart thing to do to achieve, higher volumes, higher production goals. So that's the lesson that we've learned, that you don't really need that carrot all the time in front of the people to really do well in their jobs.
That's fascinating. Thank you for sharing that, Evgeny. Jamie, what are your thoughts on this unanticipated consequences question?
Well, to some extent, from following on from Evgeny, but some unintended consequences I think generally regarded as negative, but actually I think an unintended consequence on this case could be very positive for the sector. I mean, I think if this industry does come together and does disclose appropriately its ESG and can start to win hearts and minds, can start to increase confidence and conviction within the sector, and let's be honest, it's the worst perceived sector on the planet, alongside oil and gas, then as Caroline was saying, or was it Sean was saying, it's a very small industry, and it doesn't take an awful lot to bring new pools of capital to bear to this industry. And talking to ESG impact investing funds that I've done, they're ready to invest in this sector, but there's no credible means to track ESG. So, and particularly for some of the smaller companies which don't meet, obviously, the focus of MSCI, Sustainalytics, or others. So the unintended consequence is potentially a significant new pools of capital to come into this industry to support some of these products that are so needed for the transition to a sustainable future. So I think that's a really nice positive and long-term focus that we should all be looking at.
Absolutely. That's a very glass half full way to end that topic.
I was a salesman in my earlier life, Tal, so I...
I remember it well, and I miss you very much. So we've got 4 minutes left on the panel by my calculation, 3 minutes, I think. I'd like to ask you all the following question. If you were to score how well the mining industry is moving from desire to action when it comes to ESG, and you were to score it out of 10, what would each of you give the industry as a score? Perhaps we could start with Elaine.
Well, now, how fair is that? This is a question I hadn't really thought about. So how are we doing as an industry as a whole? I'm pretty positive on, as I said in the very beginning, because mining is so close to social and environmental matters, that our leadership, that the industry at large, whether it's small, medium, or large companies, is getting this and is trying to move in the right direction. I would give us a 7. I think that there's a greater risk to society and to our sector if we don't move on these things. I think we can anticipate consequences that are more negative than unanticipated consequences if we don't move. I think we have a chance for leadership. Even though our sector is small, we impact a lot of land and a lot of people, and we can do things right. So I'm reasonably positive about how we're doing.
Great. Well, we've got 1 minute left. Can I shoot to Evgeny?
I think it's a 6.
Okay.
We've come a long way. If you go back 10, 20 years, I think the industry is in much better shape, but there's a lot to do. And I think right now there are more words than actions, and we need to turn those words into actions. So that's why it's a 6.
Thank you. Caroline?
Yeah, I'm afraid I'm in the more positive category. So I'm with Elaine and Evgeny. It's, I'm probably a 7 as well, just because I agree that I think the business is doing a much better job. I think the business and the sector as a whole is also doing a much better job of telling people what they're doing. And, you know, I know if Jenny's point of there are more words than actions, if you look back 10 years, there were no words. So,
Sure.
you know, at least we've moved forward to actually telling people what the companies are doing in the, you know, for ESG. But I think there is still room to improve.
Great. Sean, what's your score?
Very quickly, I'd say I actually think from an effort point of view, I'd probably give us a 7. I actually think we're probably closer to a 5 or 6 when you look at things from, you know, what we have to do on climate, what we have to do on things like diversity in this sector. And I'd say to Jamie's point, I think the perception of how we're doing is probably a 4 or 5. So I think we've got a charm offensive on that side, and then we've actually got to convert the effort into some actual results sooner than later.
Understood. And Jamie, what score do you give? Is it a 5 or a 7? Or a 10?
Easier job than Elaine's, given I'm last. I'm going to give it a 6, but simply because I can see an 8 or 9. We just need to help these companies, the 85% of the industry that does not produce and doesn't have all the resources. If you help them actually disclose, they have a desire to disclose, and this can be an industry that we can really be proud of.
Great. Well, thank you all very, very much for your comments. I think we'll sum that up with the industry has a high desire to implement ESG, and there's a little bit more work to do to get the 10 out of all of us. And I'd be very much looking forward to perhaps repeating this exercise in 1 or 2 years' time and seeing where we've gone. Thanks to Minds and Money, and thanks to all of you.
Thank you.